Hey guys, Ken Boy with the Accounting Accidentally website, where you can find over 350 video links to my YouTube videos on accounting and over 400 blog posts here on the page. I want to spend some time talking about perhaps the most difficult thing that you have to learn in accounting, at least in an intermediate accounting class, which is deferred taxes. So, here's the scenario. The reason we have deferred taxes at all is that book income or accounting income is different from income on the tax return. The most common example that you'll see on exams and on the CPA exam is that depreciation expense differs between book, your accounting records, and the tax return. And this is the example that I'm using. So, over a period of 4 years, we have pre-tax accounting income, we have depreciation for taxes, we subtract them to get a taxable income, we multiply that by a tax rate, and we get taxes payable. Now, important to remember that total depreciation for both book and tax purposes is the same. In other words, you bought an asset for a certain amount of money, and it doesn't matter how fast or slow you depreciate it, total depreciation is the same for both book and tax. So you'll see that if I click on the sum cell, if I use straight line, 30,000 a year for 4 years, it's 120,000. This accelerated method for tax that I'm going to explain adds up to 120,000. That is a key point. So let's take '09. We have a difference between book and tax, and we have a temporary difference of $9,600. We have more tax than book. Depreciation. So what does that mean? Well, if I take that 9,600 and I multiply it by the current tax rate, and you'll see that the tax rates differ, which makes it more complicated, which is typical. If I multiply the temporary difference, 9,600, by 30% tax rate, I get 2,880 as a temporary difference after tax. So what does that mean? Well, let's slide down to the journal entry. We've got more tax expense this year and less income, which means we're going to have higher tax expense in later years. So you've got to think about current years and later years. So more tax depreciation, less of a tax liability now, which means it's going to flip and we're going to have a liability later. So the $2,800 in the T account for deferred tax liability is a credit or liability. The check we write to the government to pay taxes today, $6,120, is less than our income tax expense by the amount of the deferred tax liability. That's the benefit, that's the real impact. Okay, let's look at 2010. A difference of $22,800 between book and tax. So, to calculate the impact, we have to add up the impact of both years, because that's why I say cumulative differences. 32,400 times 30% gives us 9,720. But we have to subtract out the 2,880 we already recognize, and we get 6,840, the after-tax temporary difference impact. So again, what does that mean? That means higher tax expense, less income now, higher tax liability later. It's a liability, so it's a credit in the T account. The check we write to the government, the taxes payable, again, is lower than the tax expense by 6,840. Let's not worry about how we came up with the income tax expense to make it even more complicated. Let's keep to these basics because it's enough. How about 2011? Tax depreciation for tax is less than book, but again, we have by $12,000, but we have to look at the cumulative difference for all 3 years. That's why I have '09, '10, and '11 in blue. Total difference is 20,400. We have to we multiply it by 40% to get 8,160, but we have to adjust for what we've already recognized in prior years, and we get 1,560 here. That is a deferred tax asset. So let's look at the journal entry. A deferred tax asset implies a lower tax expense and more income now, which means a benefit of higher expenses and lower income in future years. So it's a debit of 1560 to the T account. It's an asset. The check we write to the government now is higher than the income tax expense by the amount of the deferred tax asset. I've labeled all these liabilities, but if it's a debit, it's a deferred tax asset. Now, remember that deferred tax asset, it depends how much more depreciation is left, and that's the issue with the last year that I'm going to explain. Last year, okay? Difference is 20,400. We multiply it by 30%. We subtract off the 8160. I've got an error in the formula, but I'm going to slide down and tell you what it is. There's the 8160. It's a deferred tax asset. We debit the deferred tax liability account. It's a deferred tax asset. The check we write to the government is this year is more than the expense by the amount of the deferred tax asset. What does it mean? Lower tax expense and more income now, less of a tax expense in later years, but the problem is the depreciation is now over with. So it is a deferred tax asset, but depreciation is now over with. Now, to explain that, you need to understand that the total cumulative differences deferred tax liability and the cumulative differences deferred tax asset add up and balance so that you get a zero ending balance in the deferred tax liability account when you have fully depreciated the asset over all 4 years. And again, critical to remember, total depreciation is the same whether you use book or tax. So that's our discussion of deferred tax assets. Remember that over here at Accounting Accidentally, we now have live courses, including an upcoming course, Toughest Intermediate Accounting Topics, that's live. You can click through and sign up for that course and see what it's all about. Thanks for watching, and we'll see you next time.